Welcome to the Deep Dive. Today, we're jumping into something huge in finance right now. A really big question. Is the U.S. stock market, solid? Or are we maybe looking at another bubble? And get this, here's a crazy stat to start us off. Over 40% of the S&P 500, the big 500 U.S. companies, its value comes from just 10 companies.
Just 10? It's pretty stark.
Yeah. We're talking the big names, Apple, Microsoft, Nvidia, Amazon, Tesla, folks like that. So the main question for this deep dive is pretty simple, but deep. Is this massive dominance? Is it real strength? Sustainable? Or are we kind of edging towards a bubble situation? Okay, let's unpack this.
Yeah, it's a really compelling question, especially when you pull back and look at history. What's really striking is, well, we've actually seen this kind of market concentration before, similar levels. And historically, looking at the big picture, those periods, they often came before some pretty major market adjustments, crashes, basically.
Like what specifically?
Well, think back to the dot-com bubble. That was 2000. Or even way back to the energy crisis crash in '73. In both cases, you had this extreme concentration right before things went south. That parallel, it's kind of hard to ignore, isn't it?
It really is. It definitely gives you that, uh-oh, here we go again kind of feeling. But, okay, what about the counter-argument? The whole it's different this time idea. Is the fact that these tech giants are so profitable, does that actually protect them? Does it change the pattern?
That's exactly where things get really interesting. Because unlike those earlier times, today's big players aren't just, big. They are extremely profitable. We're talking massive, truly massive cash flows.
Real money, not just hype.
Exactly. I mean, look at Nvidia. It shot up to $1 trillion valuation, right? Fueled by the AI boom, sure, but it's based on real earnings. Or think about Apple. They're sitting on more cash than the entire economic output, the GDP of some countries. So yeah, we're not talking about those dot-com companies that had, big dreams but zero profits. These are businesses with really solid finances, products people use everywhere. They dominate globally.
The scale is just... It's almost hard to wrap your head around. Okay, so given those strong fundamentals, the big question still stands. Is this stable or is it shaky ground? How do the two sides, the two main camps, really see this concentration issue?
Well, okay, on one side, you've got the, let's call it the bubble argument camp. They look at all this value packed into so few stocks and they see, well, huge vulnerability. The worry is basically if just one or two of these giants, say an Apple or a Microsoft, if they stumble, the shockwaves could be big enough to pull the whole market down sharply.
Like too many eggs in one very large market-wide basket.
That's the idea, but then you have the not a bubble argument.
Right, and they'd say, hold on, these aren't just any eggs.
Exactly. They argue these are like golden eggs, companies that are incredibly diversified themselves with global reach, strong balance sheets.
They say these aren't just trends. They're like fundamental economic forces that have changed everything.
Precisely. They've genuinely reshaped how we live, how we work. They create real economic value. But this brings up a really crucial point for you, for our listeners, and their investments. Because if these super heavyweight tech stocks did fall significantly, your retirement account, your ETFs, your mutual funds, they'd likely take a hit.
Why is that? Because they're in everything.
Pretty much. Because these common investment funds, they often have to hold a lot of these stocks simply because they're such a huge part of the market indexes, like the S&P 500. So bottom line, less diversity across the market means your investments, broadly speaking, are just more exposed to the fate of these few companies. More risk.
Yeah, this isn't just some abstract market theory, is it? This has real teeth for people's personal finances, for retirement savings everywhere. I mean, just imagine for a second, if Apple or Microsoft suddenly dropped, say, 20% overnight.
Yeah, that'd be significant.
The shockwaves would ripple through probably every retirement account in America.
Yeah.
It really shows you how much power just a handful of stocks wield right now. And that's why understanding this concentration, it's not just for Wall Street types, it's really for everyone.
Absolutely. So, given that reality, what's the actionable advice? What can regular investors actually do? Well, diversification is key. Even though these giants are powerful, spreading your investments beyond just tech can provide a cushion.
So look at other sectors.
Right. Consider areas like healthcare, maybe energy, bonds, even small cap stocks, smaller companies. These sectors can add balance, potentially lower your overall risk no matter what the big tech stocks are doing. And maybe most importantly for long-term investors, try to remember this: market downturns. They feel awful, but they can actually be good buying opportunities.
Easier said than done sometimes, avoiding the panic.
Oh, absolutely. But history shows that panic selling, especially when the market gets choppy, often hurts more in the long run. Patience usually wins out.
Okay, so wrapping this up, what does all this really mean for you listening right now? We've dug into whether this current market setup, dominated by these super profitable tech companies, is fundamentally strong and built to last, or if we're just maybe living through another bubble, a repeat of the dot-com craze, just with different names.
Yeah, and the real takeaway, I think, isn't necessarily about predicting exactly what happens next, boom or bust. It's more about understanding that this level of concentration, whether it leads to sustained growth or a pop, it forces you to rethink how you approach investing, how you manage risk. It's really about weighing those historical warning signs against what makes today's market leaders genuinely different, and then, making informed choices for your own situation.
So the final question really is for you. What do you think? Sustainable growth powered by real profits? Or are we setting ourselves up for another dot-com moment? Definitely something to think about.